and welcome to this video module on discounted cash flow analysis, part 1 of 2. In this module, we're going to talk about the theory behind the discounted cash flow. In the next module, we'll put those theories to use in our Excel model. Discounted cash flow, also called DCF, is an intrinsic valuation method based on the notion that a business is worth the present value of the future cash flow stream it generates. This is similar to the way an accountant might price an annuity or the way bonds are priced. The trickiest parts of this analysis are calculating the future cash flows, finding the assumed terminal values, and the appropriate discount rate to use to bring future values back to the present. Bankers use a metric called free cash flow, or FCF, which we can find from our financial model. There are two widely used methods for calculating terminal value, the EBITDA multiple method and the perpetual growth method. We're going to discuss those in a few moments. Weighted average cost of capital, or WACC, is used as the discount rate to bring all future values back to the present. In a DCF analysis, it's important to note that results are highly dependent upon the major assumptions that we make. So a range of values is normally shown in what's called a sensitivity analysis, with varying discount rates, varying terminal values, sometimes even varying operating scenarios for different revenue growth rates or profitability measures. We'll see in the next module how small changes to any of the assumptions can have large impact on the evaluation. Predicting free cash flow. Forecasting free cash flow for a DCF is one of the primary reasons for creating the financial model in the first place. The model provides all of the metrics we need to formulate free cash flow. That is the EBIT, right from the model's income statement. We will then subtract taxes at the company's marginal tax rate. We'll add back depreciation and amortization, which we could find either on the model's income statement or cash flow statement. And then we're going to back out a few other uses of cash, including capital expenditures, which we see on our model's cash flow statement, and the change, or usually the increase, in working capital on the model's cash flow statement. Basically, we're trying to get at the hard number at the end of the day, how much cash is the business generating in any given year. Free cash flow figures are normally predicted for each of the model's projection years. Usually models are done on a 3 to 10 year basis. Let's talk about terminal value. The EBITDA multiple method is based on the notion that the business will be sold at the end of the projection period, and that sale price will be based on an EBITDA multiple from that future year. Let's look at an example. A 5-year projection model shows year 5 EBITDA of $200 million. The other valuation methods already examined have shown, and those were comps and M&A comps, have shown EBITDA multiples around 9 times in the industry. So our DCF, EBITDA multiple method, might show a range of exit multiples, say 8 to 10 times instead of just pinpointing at 9, giving us a range of terminal values of 1.6 billion to 2.0 billion. Again, those are future values that then need to be discounted back, and we'll talk about that soon. The other method, the perpetual growth method, is based on the assumption that the business will not be sold. It'll continue to generate cash flow in perpetuity. Question then is, at what rate does the business continue to generate cash? Let's look at an example. A 5-year projection model shows final year free cash flow of $100 million. The method tells us to grow that by an assumed rate. Let's just say it grows by 10% forever. We then divide that amount by WACC less the growth rate. So let's look at an example. $100 million growing at 10%. So I'm using my pointer here. So we've got basically I've taken 110 million, dividing it by the difference between WACC and the growth rate. So dividing it by 0.1, so 110 divided by 0.1 is 1.1 billion. In reality, this method is more useful when growth has leveled out at a mature rate. No company, very few companies, would grow at 10% forever. So this is better when your model has leveled out at mature rates, growth of 2, 3, 4%. It's then a little more valid to say, all right, that growth is going to continue into perpetuity. It's really not good practice to say, take a number on the order of 10% or so and assume that's going to happen forever. Final item to note here is that results from each method are usually shown side by side. Let's talk about WACC and discounting as the final topic in this module. Calculating the WACC. WACC stands for weighted average cost of capital, and that means it's a weighted average between the cost of debt and the cost of equity. that weighting takes place at an optimal capital structure, the optimal mix of debt and equity. Industry comparables are often used to determine that optimal mix. For example, a software company, you pretty much know the optimal mix is all equity because they have a lot of trouble borrowing. Whereas an industrial and manufacturing company might be optimally mixed at 60% debt and 40% equity. So it just really depends upon the industry that one's in. Cost of debt can either be obtained from the company's current borrowing or by talking to your bank's internal debt capital market specialist. They might say, all right, that company, sure, they'll be able to do a debt deal at 8%. All right, so then you know that's your pre-tax cost of debt. That cost is then needs to be looked at on a post-tax basis to account for the fact that interest is tax deductible. Cost of equity is based on an academic theory called CAPM, short for Capital Asset Pricing Model, which basically notes that equity investors need to earn a return in line with their risk. They can put their money somewhere risk-free, and to put it into equities, or in a particular equity, they need to be compensated for the additional risk and volatility there. So the formula, which I'm going to highlight, cost of equity is a risk-free rate, something like a 5-year, 10-year treasury, plus beta, and I'm going to go into that in a sec, times a market risk premium. Market risk premium is the historical return of stocks above the risk-free rate, and there's databases that provide that number for us. And beta is specific to the actual company we're looking at. Beta is a measure, and I'll pop down here. Beta is a measure of a stock's volatility versus the overall market. Some stocks move lock in step with the market. Their beta, therefore, is 1. Some move a lot. The market swings 3%. They swing a lot less. Their beta would be less than 1, less volatile. Some stocks, just because of the whims of the market, move a lot more than the market. The market moves by 0.5%. These stocks might move by 1%. They're going to have a beta over 1. It's also interesting to note that we sometimes need to add some other premiums to the cost of equity. Those can include a size premium, basically saying you in general need to be compensated more to invest in a small company, and a private company premium. If you're working to value a private company, it's not just valid to use this cost of equity formula. You need to reflect the fact that an investor in a private company can't just sell on the open market easily, needs to be compensated for basically being locked up in an equity investment. So that covers the WACC, and the textbook that's part of this course does a great job going in depth into the WACC theory and calculations. Let's finally talk about discounting back to the present. That can be done either with an Excel function, the NPV function. I think it's better to use the actual algebraic equation just to make sure that you understand it and you can change it for certain variables. But the basic notion is the present value is just a future value divided by 1 plus the discount rate raised to the number of years. So let's look at an example. We have $33 million that we're going to get in 3.5 years. Assuming the discount rate is 12%, that comes back to 22.2 million. And I'd be good practice for you to practice that algebra. That pretty much covers the DCF theory. We're going to spend the entire next module in Excel looking at it in practice. We'll start with a blank template and fill it in and come up with a valuation range for our case study makeup code.